You should be doing everything in your power to put your money into tax-free investments to avoid taxing your Social Security benefits. Hi friends, Colin Richards here, and in this episode we're continuing our discussion of the complexities of taxes in retirement and how you can reduce and not overpay your taxes. And we talked a little bit about required minimum distributions, that onerous burden to divest yourself of your money at age 73 so the IRS can get what they deserve, okay? Or we also talked about the critical nature of how you own your investments and making sure you're not at the whim of fund managers who are buying and selling for reasons that they don't care what the impact is on your taxes, okay? And of course, at Lord & Richards, we care very much about that. And in this particular segment, we're going to talk about the impact of Social Security. Now, here's the first thing I want to share. If you're part of the, a younger audience, let's say you're in your 50s or below and listening to this, I want you to pay careful attention. You should be doing everything in your power to put your money into tax-free investments to avoid taxing your Social Security benefits. You say, what are you talking about, Colin? My Social Security, doesn't that just get taxed based on the check that I receive? It's actually far more complicated than that. But let me just kind of give you the good news before we get into this. So if you do this right, you could end up tax-free in your retirement. You could end up having no taxes on either Social Security or any other income that you take. This is a specialty at Lord & Richards. On top of the many things that we do, we will develop a comprehensive written plan to help you reduce and mitigate taxes, along with your investment plan, your estate plan, your healthcare plan, and so on. Okay, so we don't want you to come up short in this area. And the younger you are, the more power you have in your hands. You say, well, I'm just contributing to my 401k. Well, let me start with this. Contribute to your Roth 401k. Okay, if your company offers it, contribute to your Roth. Oh, but my tax preparer says I shouldn't do that because, I end up paying more taxes now. Well, let me tell you something. Do you want to pay taxes now when A, rates are as cheap as they've been in a long time, B, when you're paying taxes on the seed? Or do you want to pay taxes down the road when you're older and a little more concerned about taxes at a rate that is unknown, possibly and likely higher, as well as paying taxes on the harvest, right? Pay taxes on the seed, pay taxes on the harvest. I think I'd rather pay taxes on the seed, right? Before the money gets too big and let it grow from there tax-free. So the good news is at Lord & Richards, we help you to do this, and we can develop a comprehensive written plan to do this. If you do this well, what I'm about to share is going to have little impact on you. But for the vast majority of people who've already been saving in your 401ks, IRAs, and other taxable types of investments, or will have taxable income from other sources such as rentals, pensions, and so forth in the future, this is very, very, very important, okay? Here's kind of the bottom line. The worst that could happen is 85% of your Social Security checks could be taxed. Let's say you and your spouse come together and you're taking $6,000 a month in Social Security. That'd be a nice combined benefit. Well, 85% of that $72,000 a year would be part of your taxable income, and you would give up a good amount of money on that. Not to mention the fact that the other income you earn from other sources is what makes that 85% taxable. Now, let's say all you had was Social Security and the rest of your income was from tax-free sources. Then none of that $72,000 would be taxable. It'd be tax-free income to you. Say, I want to do that. Well, come in and let me show you how to do it, okay? We're going to teach you how to do that. But for the majority of people, if you're taking distributions from IRAs, pensions, or even other income sources, some portion of your Social Security could be taxable. You say, well, Colin, how do I figure that out? Well, the first thing is the IRS uses something called provisional income. That means first they're going to start with half your check. So let's say we've got $60,000, and I'll just talk about a couple here. So if we've got $60,000, the IRS is going to let you earn up to $32,000 above and beyond, including one half of your check. Okay? to keep your money from being taxable. So if you're a couple married filing jointly, then that threshold is $32,000. So you realize, of course, practically any dollar, if you're getting a $60,000 benefit and you've got to include $30,000 towards your provisional income, practically anything that you make over and above Social Security is going to cause up to half of your benefit to be taxable. All right. And then if you hit the $44,000 over and above your Social Security, including one half of your check, then 85%. So it's really easy to pay a lot of taxes on Social Security, and we want to get ahead of that and avoid that. You say, Colin, well, how do we do that? Well, we're going to have to also include a discussion around Medicare. And although I don't have time for a comprehensive view of it, in addition to the impact on Medicare that your or Social Security taxation that your other income has, it will affect your Medicare Part B premiums and Part D as well. So the more money you make, and this is particularly true of high earners, they're going to take a 2-year look back at your income before you take your benefit, and then that's going to affect your benefit now and going forward. Okay, so they're going to look 2 years back to last year and the year 2 years before, and that's going to affect your ongoing cost of your Medicare premium. So it's really vital that we include not only Social Security planning, but Medicare benefit planning. We have fantastic software that we will use to help you sort through this maze. And here's the goal, very simple goal. We want to optimize how much you get out of Social Security and minimize how much you pay in taxes for Social Security and Medicare. Okay, let's say that again. We want to optimize how much you get out of Social Security, right? Get the maximum amount in interaction with your other income sources. It's not just as easy as one of these little calculators online. It's a much more complex process, but the good news is we can simplify it for you. As part of your retirement freedom review at no cost to you, we can develop a plan to minimize your taxes, optimize your Social Security benefit, and increase your freedom of wealth. That's what it's all about, folks. And for us, we would love to chat with you. My team and I would love to visit with you. It simply starts with a phone call.